All right, folks, it is episode 176. I'm here from lovely Vancouver, Canada, out here on the West Coast doing some business, visiting some friends, and boy, we have a different type of show, a little bit early, but want to get this in before we head out on a plane and get back to Toronto. But things I'd like to chat about today. Homeowner insolvencies are about to rise, and I want to talk a little bit about what's going on in BC, as well as the recent Government of Canada announcements to help out cities and provinces with a home build fund of $6 billion. We're going to cover all this and more on this episode of the Wise Old Owl Show. I'm Vince Gaetano. Thanks for tuning in. Before we get going, if you can subscribe to my YouTube channel. We just dropped another episode on this past Monday, and there's going to be another one coming out on Monday, usually around 5 o'clock. Subscribe to Owl Mortgage on YouTube. I'm also on Apple Podcasts and Spotify. Really excited about this initiative where we're bringing in guests to chat about different aspects of finance, real estate, and more. So please do that, and I'd love to get your feedback and comments. But first, let's talk about homeowner insolvencies. They're on the rise. A recent report by Doug Hoyes of Hoyes Michaels pointed out that insolvencies have started to creep up. They peaked back in 2011 at about 29.1%. Then they almost went to literally zero. Homeowner insolvencies are driven by home values, and we've seen home values go up for the last decade and decade plus, and they ended up tapping out at about 1.6% in 2022, but since then they've jumped up to 4.2, and I'm going to explain why. When there is rising values of homes, cheap money, and the ability to refinance, people are able to get rid of their unsecured debt. And now that values have actually gone down, we're starting to see these homeowner insolvencies start moving up. And we do believe that they're probably going to go up even more over the next couple of years as more and more homeowners have difficulty refinancing, qualifying for mortgages, and start tapping out on unsecured credit limits. Now, what does an insolvency mean? An insolvency isn't necessarily bankruptcy. It's usually creditor protection or consumer proposal. And this is where someone files for consumer proposal and is looking to get a break. They can't make the payments anymore, and they basically want to hold off folks and try to settle for cents on the dollar. In some cases, it could be 20 cents or 30 cents or 50 cents on the dollar, and they get terms to make payments for the amount of debt that they've agreed to pay back over a 36, 48, or 60-month period, and they have to make all those payments interest-free, and the bankruptcy trustee disperses those funds amongst those folks that are due unsecured balances. Now, do people actually lose the house? No, not really. But what's happening is the lack of equity in their home is limiting their ability to access credit and pay their debt. So what we're seeing is the composition of a homeowner insolvency is very different than someone who doesn't have a home. And the average debt load of a homeowner insolvency is about $98,700. That's a 2023 number, whereas a non-homeowner has debt of about the homeowner has 1.8 or almost double the amount of debt that they file for insolvencies, and it just shows that they're trying to access lines of credit cards to make payments on mortgages they can't keep up on. So we're going to see this trend continue. This spike to 4.2 has happened in the last 2 months of the year, and we're going to probably keep more. We're going to take more time looking at the stat because we're starting to see things break. As I've always mentioned, there's considerable struggles out there for people trying to keep up. A lot of folks are running out of money before they run out of month, and this is probably going to be a trend that's not going to end well for many. So we'll keep an eye on that. Good stuff from Doug Hoyes in this report. It's a pretty detailed one. I encourage you to read it if you have a chance. I'll try to get a link to it and try to make it available on one of my posts. But a very good report and something we really got to keep an eye on. And you're going to start seeing over time the lag effect of these rate increases and folks running out of available credit to access to do such. So interesting there. Federally, the Liberal government is on a spending spree. They're going across the country every day mentioning new spending measures that they're going to probably finalize in their budget in the middle of the month. And their most recent one is a $6 billion home build fund that they've come up with, of which the breakdown is $1 billion for cities to deal with emergency infrastructure, and another $5 billion to the provinces to help out in infrastructure, building, and whatnot. But the problem is there's a lot of strings attached, okay? All these provinces have to make sure they abide by certain measures that they have to hit. So they have to all adopt the Renters' Bill of Rights. They have to deal with deferred development charges. They want the provinces to defer development charges for building for at least 3 years. And we're also looking at these provinces having to meet density requirements. So they have to allow at least 4 units on properties across the board. So, will this money be spent? I doubt it. I really think that this is all a publicity stunt to try to move the needle with voters and trying to believe that they are doing something. But the reality is they're stomping on provincial jurisdictions and municipal jurisdictions. And these funds, when there's strings attached, really don't mean anything, right? Like, let's look at the development charges. If provinces waive development charges for 3 years, will it amount to more than what the grant is, or the $5 billion is? I don't know. Like, they would do the math and say, why would we give that up and take this money and be worse off? So I'm not really sure why the government is trying to put their pressure on provinces and municipalities when this is really an immigration problem. At the end of the day, they've opened up the floodgates. There's more people here than need to be, and they've simply fucked up. They fucked up this file. And just recently, I read that the Prime Minister has mentioned that immigration is out of control and they got to tighten it up. Well, that's on his watch. Like, this isn't a surprise. And they've obviously been caught with their pants down. It is a disaster, and I think it's only going to get worse. So, folks, buckle up, tighten the chin straps. It's going to be a bumpy ride. Out in BC, very, very interesting scenario out here. Been keeping up with what's happening in the city, especially Vancouver, and it is absolute disaster. They're in full crisis mode on affordability. I had the opportunity to meet with a bunch of folks. I want to thank Sachin Varma, who met with me when I came in. I was a little bit late, plane was delayed, and he held in there waiting for me, and we had a great chat about the affordability crisis. And I just want to point out a couple things, and I'm just reading some notes because it's early here, but one thing that has been pointed out by an RBC report that just came out, and that is that the percentage of medium household income that is going towards home ownership has steadily increased over time. And in the 2000s, it was in the 30% range. And then a decade ago, it was just under 40%. And now, just this last quarter, it's hit 63.5%. So 63.5% of the medium household income, which is set at about $85,400, is going towards home ownership. In Vancouver, the percentage of that medium household income has hit 106.4%, which actually means nobody can afford anything here. a townhouse in West Van is like $3 million. The amount of property values here is just crazy. It's astronomical. And I don't know how folks are going to survive. This is a major crisis, and all the papers are indicating that they are in crisis mode. So a real struggle here. Not sure how they're going to get out of it, but it's really, really crazy. One other stat that I picked up here is, it's just in the paper the other day, the net migration out of the province is 68,000. So 68,000 people left BC to go to other provinces. Over 50% of them went to Alberta. And the main reasons for them leaving is economic opportunity and cost of living. And they are unbelievably upset about the carbon tax out here. In having lunch with a few folks, they are unbelievably surprised at how much momentum the Conservative government has gotten in BC. And I think that tells a tale. This province is predominantly NDP run, Liberal run, and the Conservatives really haven't had much success, but they are gaining momentum. Their message is clear, and it's going to be really interesting how all this plays out here. And people are talking about it. Everybody's talking about the cost of living. People are talking about the crisis here, and I don't know how it's going to get better under these governments. We need more accountability. We need some transparency. And quite frankly, they got to get their fiscal house in order. It's really an interesting scenario here. It is beautiful, I'll tell you. I had some rain on the first day, but yesterday was a beautiful day, and I'm really fortunate to have some great hosts who have really shown me a great time. So hats off to the Charlwood family, Chris and Martin, Chris Turcott from the Centum network, who has allowed me to use their boardroom, and this is what they look out to. It is a fabulous, fabulous town, beautiful vistas from everywhere, and I'm truly blessed to have the opportunity to shoot from here. So thank you to the Centum family and allowing me to do my thing. A couple other things I want to point out. There's a lot of folks that are struggling. And one of the things that I've noticed over the last few weeks is people's inability to know where they stand on a monthly basis. And I am going to point out a major flaw in the big banks' elimination of printed bank statements. To save $2, you could get all your statements digitally. And a lot of people don't necessarily know what goes through their bank account other than the 4 or 5 transactions that they see on their phone because of the evolution of online banking and everybody being able to access their account through their phone. Most recently, we dealt with a client and we asked them to print out their last 6 months bank statements and credit card statements. And we had one individual, and I'm not trying to center out this one person, but this is just one case. They had about $3,200 in Uber Eats charges in a month. And they were surprised by that. And the reality is they have a few kids and their kids have their accounts, and all they see go through their account is, $7 charge, $12 charge, not a big amount, but, on a constant basis. And it really doesn't faze them because it's a small amount. But the reality is their statement was about 7 pages, right? And all those amounts add up. And unfortunately, when you're only seeing 4 or 5 transactions on your phone at a time, you lose sight of how much they add up to. Now, $3,200 is a lot of money, okay? And I think we really need to drill down on budgeting. I really feel that there's a significant opportunity for folks to get a hold of their finances by just taking half an hour a week out of their day to just know where their money's going. And it's an interesting exercise. And when we do it with our clients and we kind of go through the subscriptions that they don't know what they're for, items that they realize they don't need, it really adds up to significant dollars. And I encourage people that are feeling a bit of pressure with the cost of living is to go into your bank accounts, go into your credit card statements and print out the last 6 to 12 months and go through them and look at the behavior that you're into and understand that there's probably things that you don't need, those wants. You don't need them. So focus on what's vital, focus on what is required, and chances are you're going to find some savings. And I know I'm not trying to pontificate and try to talk down to people, but more and more folks that we work with find savings in this little exercise. And you don't have to do it with me, but you could do it on your own. And I truly believe that when you go through that exercise, you will find savings that is going to help you. It might take a bit more burden off your shoulders and give you some breathing room. And that's what people are looking for. They need a break. They need to breathe a little bit. And I think this is a simple exercise that I encourage everybody to do. And I truly believe it'll give you, it'll be enlightening. It really will. And it'll be something that I think you'll enjoy and appreciate. So, there's that. We are seeing a lot of folks starting to get renewals. They're getting calls early from banks about renewing early. And I want to make something very clear. You have a rate that you negotiated 4.5 years ago, and you got 6 months left at a low rate. There is no rush to early renew, folks. Okay? You should be using that lower rate right to maturity. And if any bank is trying to pressure you into locking in now, they're doing you a disservice. They're really causing you to make a decision that you don't necessarily have to make until your maturity date. And if you think they're not going to offer you that and give you these high pressure tactics, you're dealing with the wrong institution, right? If they really want to help you, take that rate and let them know that I will be happy to take it at the end of my term, but I want to exhaust the remaining interest rate, which is more favorable to me in most cases than the one I'm going to be paying. So don't give up on those 1.5 or 1.99 or 2.5% rates and pay 5. Okay, like it doesn't make any sense. And my colleague and friend Ron Butler put it bluntly. You don't have to fucking do it. So don't get cornered and pressured into doing this. Take your term right to the end. They have to offer you a renewal and shop it. Do your due diligence and understand that you should take the full extent of that term at the rate you negotiated, and it's a more favorable one. So why would you want to switch that? So don't fall for these tactics. Be very aware of your options, educate yourself, and shop around. There's a lot of great experienced mortgage professionals in the space. Reach out and ask for some assistance. And you'd be surprised at what's out there and the number of people that can help you out. I do encourage you to use someone with experience. I think it's critical that you deal with someone that knows what they're doing, understands the market, and will give you options. Okay, there's not just a 5-year option. There's 1 year, 2 year, 3 year, 4 year, 5 year. Everybody offers you all kinds of options, and you have to make sure it matches with your requirements. So do your due diligence. You'll do yourself a great service. I'm not sure if there's anything else I want to cover, but I do encourage everybody to subscribe to my new YouTube podcast. The videos on YouTube. We also have audio on Spotify and Apple Podcast. It's the Owl Mortgage on YouTube, the Wise Old Owl podcast on on Apple Podcasts and Spotify. Please subscribe. I'd love to hear your comments. And I'm going to wrap it up. From Vancouver, I'll be back to my regular slot at 4 o'clock next Thursday. I want to thank everybody for tuning in. And if you have any comments, feedback, or thoughts, please share them. A little bit under the weather, but I want to make sure I get my episode in for you. So take care, be safe, and we'll talk to you soon. Bye.